Hello and good evening. Hi, Natalie. I think you got your mic on mute. You need to unmute it.
Okay, sorry. Hi, Benny.
Hi.
Good evening.
Okay, it's glad you can join us tonight.
Yeah.
Okay, so we are now live. Guys, thank you for joining us tonight. Our investor copy time at 8 p.m. And today we have our guest, Natalie Ong, who is the research analyst, right? You are from Phillip Securities Research.
That's
And
right.
he specializes in REITs. Am I right?
Yes. Yeah, that's right.
Okay. So today we're going to talk about US Office SREITs or Singapore REITs, right? Where you're able to access US REITs through Singapore. And Natalie is going to share with us, maybe in a short while, Natalie, you can also share with us a little bit about yourself, your background. And then you have slides to also show us, right?
Yeah, that's right.
Okay, great. Okay, so welcome once again, guys. And thank you for joining us tonight. I know tomorrow is also the election, or tonight or today, right? Is the election day for a presidential election in US. I'm sure there'll be a lot of questions asking about that as well. Okay. So before we start, whatever that's being shared here today is for educational purposes. It's not intended as any investment advice. So if you want to look for investment advice, please do look for a professional and licensed investment advisor. All right. Okay. Hello, Emily. Thanks for joining us. All right, so Natalie, over to you. You can just tell us more about yourself, and then you can start your presentation. And if there are any questions, I'll basically bring the questions to you, lah. Is it
All
okay?
right. Yes, sure.
All right, Natalie, over to you.
Okay, so hello everyone, and yes, I'm a research analyst with Phillip Securities Research. So primarily, my role is to look for listed counters that I see value in, and I believe will bring investors some returns. Of course, some of the things that I look out for are they have to be fundamentally sound, and I like to find companies that actually do provide some growth. I want a DPU growth, especially in the REIT space here. And yes, I cover the REIT and the property sectors of the stocks that are listed in the Singapore Exchange.
Yeah, I was looking at REITs in US. Their dividend yields are quite attractive, isn't it? I mean, compare, let's say, even the Malaysian REITs or even Singapore, I think they really provide quite good returns or good dividends, right?
Actually, for US listed REITs, they're considered more. I mean, they structure themselves or they manage themselves more like a growth stock. So actually, typically, if you talk about DPU, the DPUs are not fantastically high, probably around the 3%, 4% range, but they do provide some growth because of some of they don't pay out most of their dividends, unlike in Singapore, where actually there is a clause that says in order to qualify for tax transparency, which means that REITs in Singapore, S-REITs, do not actually have to pay corporate taxes, which is an advantage. In the US, they don't have this. They are able to actually retain some of their earnings and invest it in, for example, developments. So that actually provides them some growth. Yeah, but in terms of DPU wise, it's quite low. So in Singapore, right, we look at REITs more like yield kind of investments. So if you have $1 million and you pump it into REITs, and then it's going to give you, let's say, 5%, 6% returns over, for the rest of your retirement life, per annum.
So I mean, the total returns with capital gains are because it's reflected into the prices of the REITs itself, right? In the US, if that's it retained.
Actually, no. So the dividend yield is mostly just dividends itself. Capital gains is separate from it. It could be high. It really depends on the cycle. Yeah.
All right.
So,
okay.
Yeah.
Okay. Yeah, I need to hear more from you as well, because I personally have not invested in US even stocks. So REIT is something which is I think is a good platform to get started with, right?
Yes. So would you like me to share my screen?
Yes, sure.
Okay. Here we go. All right. Oh no, did I share it yet?
Not yet.
Okay. Here we go. Did I? I said it.
Okay, now you're sharing. Yeah, you can present it now.
Okay. So The topic for today is the the US Office Singapore listed REITs, so SREITs for short. And then, but before we go into that, I'd just like to show you the performance of the Singapore REITs in comparison to the STI, which is the Straits Times Index, which is our benchmark index in Singapore, and which is the red line here, as well as the property developer index. So you can see the blue line, which is our REIT line, is actually outstripping. It is outperforming the STI, the country benchmark, as well as the real estate developer benchmark. Of course, year to date, if you look at the returns, year to date we are still down about 12% ish, but this of course is better than the other sectors or the other indices. Yeah. So actually, this month, if you see, this month's returns was actually slightly negative. We had a hard month this October for the REITs. I think it was generally in line with how the market traded as well. The market went up. Yeah. So it was hard. It was a hard month for the REITs.
Okay. Sorry, it's hard month for everybody, right? Yeah. Except for anything that's got to do with COVID related, like the health and cloud and all that. But other stuff.
Okay. So this slide here actually shows you the light blue line here is the price index. And then this darker blue line is actually the dividend yield spread. So the dividend yield spread is the dividends, the 12-month dividends, historical dividends, minus away the 10-year bond yield. So in essence, if let's say you are a really conservative investor and you don't mind holding bonds, you probably get you can see here it's like really low, less than 1%. It's like 0.8% right now. And then, considering that REITs are supposed to be more a safer asset class in a way, risk adjusted wise, if you minus away the 10-year dividend, 10-year interest rate, this is the dividend yield spread that you will get. So the red line is the average over past the history, and then we are somewhere near the average right now. As compared to 2019, you see that actually REITs had a really strong year in 2019, and it was really expensive to get in. So right now, COVID, blah blah blah, and then the prices went down. I think overall we can still say that it is a better entry price for the REITs currently.
Right.
Yeah. Okay, so not sure if you guys are interested in this, but these are some of our Phillip Research stock calls. So we have some of our hospitality. Then recently, the merger between CapitaLand Mall Trust and CapitaLand Commercial Trust, Fraser Centrepoint Trust, which is a retail REIT. Then some China, and of course, our top picks are the US office REITs actually. So it's Manulife Prime, and then we have some industrials, Ascendus, and Keppel Data Center.
Mm-hmm.
So the highlight for today's presentation would be the US Office REITs.
Right.
So as you can see, I draw your attention here to the yields that we are actually projecting. The yields are about 8% for FY20 and FY21. Yeah. So for Manulife and Prime, including our capital returns, which is basically we are projecting a certain target price, and then from the capital appreciation is the current target price versus the entry price, which is your current share price. So altogether with your dividend yield, we are actually forecasting a 30% return for Manulife, as well as for Prime 21%.
Yeah. The dividend yield that you have calculated here is basically based on the historical dividends, right?
No. So when we do have this kind of like coverage of these stocks, what it actually means is that we deep dive in the stock. Right. We look at the lease structures. We look at who are your tenants. What are the kind of escalations? How is the market like? Are you able to get positive rental reversions? Meaning, are we going to see rental growth in that particular market, etc. And then we make a forecast, sort of a calculated guesstimate here, and then we input the numbers, and that's how we get our forecasted revenue, forward-looking revenue. Yeah, and so when you see the E here, it means estimate. So that means we FY20E, FY21E DPU. It means that we actually calculated it based on the best possible knowledge that we have, and then this is what we think that the yields will be. So the DPU and the yields.
Right. Because we actually have a question here, right? Because now that we have this, people are encouraged to actually stay at home, although US is not as strict as the one in Malaysia or Singapore, where we actually have our control movement order, right? A But do you foresee this lockdown? Although certain states in the US there are lockdowns, will drastically affect the returns from the US office REITs or US property market?
Okay, actually, it is true. So, like, while certain states there are lockdowns in certain US states. Similarly, in Singapore, we also had a 2 month circuit breaker. I'm sure you're aware, where we were discouraged or not, we were prohibited from going back to the office. So,
Right.
these leases are actually contractual in nature. The lessees have to pay the rent, whether or not you are there, you're not there. There's 2 people there, 3 people there. You still have to pay the rent because these are contracts. Yeah, and then it is true. So while during the lockdown, the periods of lockdown or whatever they are terming it in the US, the office occupancy, physical occupancy of the number of people inside the office, is actually really low, about 10 to 20%. But the lessees are still they still have to pay for the rent. Yeah,
You
and
still
in
have to
fact,
pay.
when we look at one of the metrics that we look at is collections. So, accounts payable, right? So how long does an account take to pay the rent that they owe? In fact, if you look at the US, like your Prime and your Manulife, the collections are still very much in line with historical collections. So, like, for Prime, about 99% of their rents are collected promptly, and for Manulife is about 93% that are collected on time. That means in line with historicals. It's not as if like 50% of your tenants are in arrears. Yeah, so it's a very good
Right.
healthy situation.
Oh, okay, yeah, same. I mean, we have been. I mean, even in Malaysia, we have been in a CMCO or CMO since March, and we still have to pay the rents no matter what, right?
Yeah.
Yeah. So, 91% is still a very good collection that they are actually having, and that's the reason why that's probably one of the metrics that you look to actually do an estimate for 2020 and 2021 as well.
Yeah. Yes. Also, of course, like if let's say the impairments or the debt collection tends to stretch, right? Like maybe 2 months, 3 months, then that's a red flag, and we're like, oh no, what's happening? Is there probably going to be an impairment on receivables, and that would affect the distribution amount, because you might not be able to collect it. So then we will have to reduce our forecast of earnings as well as distributions. But currently, it's still quite healthy.
Right. Sure. All right. Great. Okay.
So
You can carry on.
okay. So, okay, this slide here, actually, I know it's a lot of numbers and it's a little bit small. So this slide here actually shows you the difference between the Singapore office REITs and the US office REITs. So the top, oh, sorry. Okay, the top three here, these are the SREITs that actually have properties, assets that are in the US: Manulife, Prime, and Keppel Pacific Oak. Okay, so and this compares to CapitaLand Commercial Trust, which was previously, before the merger happened. This is a pure play office REIT with majority of the assets actually in Singapore. So it's a very good proxy for the Singapore office market. And for Keppel REIT, they do have several assets overseas, like South Korea, but predominantly most of their assets are in Singapore. So it's also a good proxy for the Singapore market. And that being said, right, whenever you invest in REITs, what you're actually doing here is taking a sort of a bet on the economy of where the assets, the country where the assets are located in. So, if, for example, you are investing in Singapore offices, the Singapore office REITs, like your Keppel and your CapitaLand Commercial Trust, that means you sort of believe that there will be GDP growth that will propel the rental growth, etc. Similarly for the US. Yeah. So of course, these are the. Oh, sorry, this is a typo here. This is the US listed US office. Sorry, this is a typo here. So this whole chunk below, these are all the US listed office REITs. Okay, and then some of the differences, like I guess some of the questions would be like, okay, so why do I have to buy, office REITs from Singapore Exchange? Why can't I just go to the US and buy? So as like why don't you go straight to the source, right? Why must I go to another exchange? So okay, I guess one of the reasons is that like as I mentioned, in Singapore we are sort of, I wouldn't say kiasi, but we are like more conservative in a way. Okay, we have everything to protect, not everything like, okay, we have a lot of measures in place to protect the investor, such as your 90% mandated distribution. They have to distribute 90% of their earnings. This is so that it will appeal to investors who are actually looking for dividends, stable earnings, right? for people who want to invest their retirement money, etc. And then also we have actually a more conservative gearing. Previously, just last year, we currently actually lifted the gearing limits a bit, but actually we were one of the lowest gearing ratios amongst all the developed REIT markets. Yeah, US has no gearing limit. Means you can leverage 200% if you want. I have 100 million worth of assets. I can borrow 200 million. So some investors might not like that, might not be comfortable with that. But in Singapore, our gearing is relatively low. It has been lifted from 45% to 50% during this period. During this COVID period, because it is expected that some of the the earnings will take a hit, right?
Right.
So they have actually lifted the gearing in Singapore by 5% to prevent any accidental breaches of this gearing limit that is out of the control of the REIT managers. So one of the things, the difference is that Singapore, we have more sort of regulations. Even with this lifting of the gearing, they also try to implement this like adjusted interest coverage ratio, which will kick in 2022, where they say like, okay, look, you still must, even though you can only lift your gearing up to 55% if you are able to show that the amount of earnings can cover your interest payments as well as your payments to your perpetual security holders at least 2.5 times. Yeah. So that is in a way also an assurance that as investors, even if you're a debt security holder, you will get your payments. Yeah. So in that sense, there's a safety there. And also Singapore has a sort of a development cap. That means most of the money that the REIT has, most of it has to be invested in stable income producing assets. Meaning right off the bat, they are already going to be collecting rental, etc. And the amount of development projects cannot exceed 10% or 20%. So meaning to say that you won't really see the case where I'm buying this asset and I won't see the returns in like 5 years. Yeah, so that's Singapore for you.
I see. Okay, so it's more protective when I invest for investors, lah.
Yes.
Yeah.
Yeah, so another thing just now I was mentioning about the dividend yields, right? So you see this trailing yield over here. For Singapore, right, this is historical, of course, 10.6%. These are the yields that you see. Singapore Office REITs, they tend to have a slightly lower yield, 5.1. Actually, it's more towards the 4% right now, dividend yield. And then you see the US one is actually way lower, 2, 4, yeah. So these are actually the top 10 US office REITs. So this is one of the differences also. And one of the reasons why this is so is because in US, they are, like I mentioned, they don't have to pay out 90% of their earnings. You can actually take the money, reinvest it in redevelopments or, build from scratch kind of projects. And that's why the earnings is slightly lower. So if someone who wants dividends, a retired person who wants to grow their dividends at a stable rate, then they might consider REITs. Yeah.
Right. Okay. So that's one of the main difference, lah, right? That 90% mandate that when they listed in Singapore, they actually have to give it as dividends, right?
Yeah.
Wow, interesting. Okay.
Okay, so now we jump right into the US office REIT. So just want to give you guys a bit of a feeling of what the US office sector is like. So first of all, I think one very big difference is that the US we call it lease expiries. So the lease expiries, the kind of terms that the lessees typically enter into in a lease negotiation or lease term is usually slightly longer. Actually, of course, it depends on the size. If you're a smaller outfit, maybe you're a SME, you might actually tend to take a smaller space, maybe or rather a smaller space as well as a shorter lease term, like 5 years, 3 years. And then, but as you can see over here, majority of the leases in the US market are actually long dated. For most of them are like what, you see, 4 to 8 years, 8 to 12 years, 12 to 16 years, and those that are less than 4 years is only like 6%.
Oh, okay.
In the US, technically they do tend to sign for a longer lease term. So what this actually means, right, or the implication is that a lot of these REITs, the kind of, we call it WALE, weighted average lease expiry. So the WALEs are slightly longer. Just move back here. As you can see, the WALE in the US REITs is like about 5%, 4 to 5. Whereas in Singapore, it's usually lower. It's about 2 to 3 years WALE only.
Okay. Yeah.
So this is the difference. And what this actually means is that the longer the whale, it means that there are there are smaller percentage of expiries coming due in the most recent or coming financial year. So as you can see, later I'll show you guys in like FY20, FY20, FY21, the amount of lease expiry is actually less than 10%. So as I mentioned, all leases are actually contractual in nature. And the US leases typically do not have break leases. There's no like, oh sorry, tomorrow I change my mind, I want to break my lease. No such thing. So they are contractual in nature, and they are sort of tenants are locked in unless you come in bankruptcy or whatever, right? So this is one another thing about the US office sector that we like, that there is visibility, income visibility, because we know that look, there's very small leases, and so it means that near term fluctuations, like for example now COVID, it could be the fact that some businesses are going under, or no, there might be downward pressure on the office rents. Yeah, and we don't want a very huge significant portion of the leases that are actually going to expire that might actually swing your earnings. Yeah, so that is a protection in a sense, in our view. And of course, as mentioned just now, the office valuations are supported by high collectability of rents. It means that high percentage of rents that were collected, about 99%, 93% were not in arrears, collected promptly. Another metric that we saw was that the S&P Global Ratings, they actually did a study on the CMBS, which is collateralized mortgage-backed securities, and these securities, they actually collateralize like maybe office assets, hospitality assets, and then when you look at these asset classes, your hospitality, your asset, retail, your office, you can actually see that the office building, the delinquencies in the office kind of CMBS was only 2.2%, versus you see the lodging assets, the delinquencies, your hotels, service residences, they were hit, of course, harder, right, because of the border closures and everything. Actually, the delinquency rate was 22%, and also for your retail properties, right? So in a sense, we see this as stability, as less fluctuation in terms of valuation as well.
Right.
Yeah, and another thing, of course, is I mentioned the long leases. Yep, and when we look at unemployment, I mean, earlier in the year, June, we saw the US unemployment was like what 17%, and everyone was like, oh no, oh no. But the thing is, if we look at if we really look in the numbers or the sector breakdowns of unemployment, we see that office unemployment rate was actually more muted. It was more controlled. It didn't even hit the double digit, not even above 10%. So this September, it was only 4.4% unemployment in office sector workers, versus the 7.7% in the US itself. Yeah, yeah. So they are sort of less hit, lesser hit. Yeah. Similarly, also professional services, the sector of professional services, I think a lot of them also are tenants within offices, and they were also similarly less hit than talking about the entire US itself.
Okay.
And one.
Yeah, so no questions yet.
Okay, I'll move on. All right. So, another thing that we did notice about the US sector is, of course, I would like to draw your attention to the graph first. This is a workplace survey conducted from 2013 to 2019. So it was, free from the impact of COVID. It's like we're just seeing on a normalized basis, the trend of workplace working or office working employees. So we see that over the years, the dark blue bar is the earliest year, 2013, and then of course the middle bar is 2016, and then the orange bar is the most recent, 2019. And then we see that collaboration, be it virtually or in person, it has been on the uptrend. In fact, right, free from the implications of COVID, collaborating in person, face to face, not just virtually, has almost doubled, 17 to about 30%, slightly less than doubled. Collaborating virtually also has doubled. So what we can see is that it's not as if collaborating virtually really spiked and then like collaborating in person fell. It both increased in tandem. So you can see that actually, while collaborating, creativity, being in a group actually helps you can bounce ideas off each other. There are benefits to it. It happens virtually, yes, but it has also happened. The preference is also collaborating in person.
Right.
From COVID. So it just means that, I mean, pre-COVID, there was already Zoom. We see Zoom, all these video tools, etc. We can collaborate, but the thing is that we don't. Sometimes the preference is still to see your colleague face to face and talk and brainstorm. Yeah. And of course, like you can see, your working alone has actually been on a downtrend. So this is actually very positive for the need for real office space, the need for offices, and not everybody work from home. Sometimes it is good to have like a meeting area, a brainstorm area. Yeah. So this is a very promising statistic.
Well, yeah, I was expecting actually that meeting virtually will go up, and collaborating with person or face to face will go down, but the data shows otherwise, right? Because you are now in the technology age, everybody is going virtual right now. But yeah, so there is the need for actually getting together is still there, lah. Still quite
Yeah.
high, right? So, wow.
Yeah. So free from COVID, actually, we see that the trend has been both collaborating virtually and in person equally important. Both maybe not equally, because collaborating in person, as you can see, is almost double than collaborating virtually. Maybe now that has changed a little bit, but in general, yes, collaborating in person is still preferred mode, free from COVID. Yeah.
All right. Okay.
Yeah. So also another thing to note is that, while Singapore, I'm not sure about Malaysia, but in Singapore, most of the workers in Singapore, we actually do go to work. We don't remote working or working from home is actually not a commonplace pre-COVID. It's only due to COVID that's why we are all forced to work from home. But free from that, right? In Singapore, remote working percentage is actually very low, versus in the US. Uh, Before COVID, a high percentage of people, about 40%, have some sort of flexible working arrangements where they are allowed to, choose the days that they want to go into office, or go to office 3 days, stay at home 2 days, up to them. So in that sense, right, the US market is sort of more developed, and it has been sort of tested in a way where those people who were allowed, or given the flexibility of working from home, they're already doing so before COVID. And it's not as if like right now we are just experiencing working from home. So of course there might be some of us who are like, hey, yeah, I really like to work from home. Versus in the US, it has already been a commonplace for them. Yeah, and I think recent studies actually show that after COVID, the incremental amount of people who actually said that they now prefer to work from home was only 2% more. So that is also very reassuring for the office sector in the US. Yeah.
Yeah, I guess it's actually easier to work in the office rather than at home, because at home you have other stuff to do. I mean, like personally, we have been also at home, and we have family, we have children. It just, I mean, you probably spend lesser time working at home, right? And then in office, because you're more productive. You're not basically hindered by a lot of noises, right?
Yeah.
So yeah, I mean, it's like we all have been. I'm not sure about Singapore. Like even in Malaysia, I mean, we just about to get out of the lockdown, and then we are back in the lockdown again. And before we actually want to, when we started to go back to office, it's like, wow, everybody was so happy, right? Yeah, but yeah, this so the survey is quite interesting actually, right? That people still need to go to the office, and yeah.
Yeah, but it's not to say that, I mean, of course, yes, that those people with families, I think that it is true that the distractions from having to take care of the children who during the lockdown couldn't go to school, etc., and the pets and everything, it would hinder your productivity. But I guess there are some people who also share the view of they prefer to work from home because time saving, don't need to do your makeup, don't need to dress up, don't need to travel 1 hour out to the CBD area. So I think that there are two sides of the coin, but all in, right? I mean, I speak from a very unbiased point of view here. Like more realistically, yes, I think that in Singapore at least, remote working or flexible working arrangements will become more common versus in the past where almost 100% of people just go to office. I think right, like there is a chance that it will happen that flexible working arrangements will be more of a commonplace, and that might mean that that there will be some right sizing. That means perhaps in the past I used to take 100,000 square feet of space. Perhaps now this office will reduce the square feet. It means like let some of the people work from home and maybe convert the desks to like hot desks. I mean, not to say that we do away with offices. We might change it to reconfigure it for like meeting spaces, collaborative spaces, etc. But like essentially, I think the demand for office, the need for an office address will still be there. Yeah.
Yeah, I guess probably in Singapore, working culture is probably more closer to US than in Malaysia. Right? Malaysia, we are still a lot of people are still need to go and clock in at 9 and clock out at 4 or 5, right? But I think probably in the US is almost similar, like in Singapore, where people actually have flexible hours and flexible time to actually get in, as long as they get the work done, right?
In Singapore, not really, but I think we are trending towards that way with the more flexible working arrangements, remote working. Yeah, I think that we're trending towards that way.
Okay.
Okay. So of course, right, when we look at the market, we see where is demand coming from, which sectors. The top three leasing drivers are, of course, the tech companies, and the financial and the professional services. So, I mean, tech is a very broad subject, right? What is tech? Okay, so just to give you a flavor, understand, some sort of clue on what are the sectors of tech. So we have on-demand services, which is, of course, I think one of the biggest sectors in terms of tech. On-demand is like, for example, your I don't know, Grab. In Singapore, we use a lot of Grab food, Grab car, or Lyft or Ride, or this kind of on-demand services, or even your Netflix is the on-demand kind of subscription. Then of course you have your e-commerce, it's also part of tech. Fintech, which is like lending your wallet kind of application. So of course, Singapore we have Grab. Grab has a wallet on its own, and it's a FavePay. I'm not so sure about Malaysia, but so these are all technology companies that are actually growing because technology is the future. We also have your big data, digital media, social media, consumer electronics. Yeah, so this is where some of the US is actually predominantly a sort of a tech kind of. The tech is a growth sector in the US. Yeah. So this is also I mean, given that now technology adoption penetration is even more prevalent due to remote working and how we have gotten accustomed to perhaps ordering or using logistics, using e-commerce more. So these are tech will only grow even faster, accelerate the growth of tech. Yeah, and these are
Right.
also the drivers for office demand.
Yeah, I think one of the things that people do not see as well is that although we have tech and everybody thought tech is just it just comes from the cloud, right? And you don't have but people don't know the infrastructure behind, right? All the servers and all that needs to be stored as well, right? And they need to be used in office space and all that. And of course, US is huge, right? Yeah, probably in Singapore and Malaysia we have data centers and all that, and it's still growing and still continue to grow. Yeah, the need for office space or industrial. So the one that you talk here, when you talk about US office space, is not including the industrial.
Oh yeah, no, it's not. It's not. Yeah,
Okay.
these are more of like your headquarters for even like recently we heard that TikTok wanted to go to the US, but I think because of Trump and then he's not very pro Chinese, so they
Right.
were sort of I mean while like for example even your social media you still need the people, the marketing team that actually, or the coding people who actually study the usage of your patterns, your behavioral patterns. Oh, this person is more likely to click on something regarding technology, computers, sound speakers, etc. And then that's how they churn it. So, or these the people who churn the data, the big data, or the people who target the marketing to write the code, or to know which ads to push to you. So I think those are the people who actually take up like office space. Apart from, of course, yes, there is a growing need for data centers. Yeah.
Right.
Yeah.
Okay.
Move on. Did I miss something? Oh yeah, sorry. So this is actually the same points, but just that you can see that technology has been the predominant net leaser. Yeah, the most take up is actually from the tech space, then followed by finance and insurance. Yeah, and co-working is actually your WeWork type of outfits, like your service offices. Yeah, where
Right.
where you have more flexible shorter leases kind. Yeah.
Oh, that comes third.
Yeah, real estate kind of demand.
Oh.
Yeah, but of course, that's actually quite opaque because we don't really have a lot of information on who are the kind of tenants that are actually taking up this kind of like very short term office space. But actually, what we do know is even in Singapore, because I'll use the TikTok example, right? So ByteDance wanted to go to US, and then like Trump sort of said like, no, we don't want we want you to sell the asset, sell TikTok to another US firm, so that is more separated from the Chinese side. And then even so, actually in Singapore, then they decided to come to Singapore. But actually, what people don't realize is that TikTok has actually already been in Singapore since 2018, but they were in a co-working space. So these co-working spaces, right, or offices, they actually appeal to smaller outfits or people who are just like testing the market. Like before I really say I want to move my headquarters here, I'm going to see how the the environment is, etc. And then it is like they pick up small space, and then once they say okay, look, I don't mind really moving my headquarters here, and then they start to expand. Yeah.
Right.
Yeah, so that's what co-working is good for, I guess. Okay. So of course there are some risks associated. Everything has risks, right? Like it's either you take a
Oops.
demand for offices, but of course, oh no, did we just disconnect for a while?
Yeah, a while only. Okay, now you're back. Okay.
Okay. Yeah. So I mean, of course, there are always risks. So we look at it from we also look at the risks when we build our models. So of course, one of the risks is the weaker economic outlook. Because of the COVID situation, and then like some businesses are under pressure. Yeah, and then of course, when they are pushed to a more mobile operating model, there might be more higher adaptation of telecommuting, remote working. But as mentioned, right, in US, that risk is actually really relatively low because pre-COVID they have already been employing a relatively substantial amount of remote working. Yes, yeah.
Right.
Yeah, and of course, there's one more risk, which is downsizing and consolidation. So it means to say, like, for example, your banks are starting to take smaller space. Because of course, if you're renting a prime CBD kind of asset, like for example in Singapore, if the banks are going to rent CBD quality kind of assets, the rent is actually quite steep. So everyone is tightening their belts as the years go on, so they can show more profits and etc. So this consolidating and downsizing has actually been a trend, or it's a slow process lah. Yeah, and so this might also continue on further. Yeah, especially with more companies actually wanting to go more employ more remote working.
Right.
Yeah, and, yeah. So this leasing and supply headwinds. So similarly, when businesses are under pressure, we actually think that the businesses will shelve their expansion plans. Meaning, like, look, actually we want to expand, but maybe now is not the right time. So that might actually sort of there's no boost in terms of like demand for space temporarily because everyone's like cautious and adopting a wait and see approach.
Right.
So this is one more thing that I would like to mention. So tax transparency in Singapore. I mentioned that as long as the REITs pay out 90% of their dividends, DPU, distributable income, then they are entitled this tax transparency. So in US, right, most companies they actually slapped with if you invest in a US counter, not a REIT counter, just a US counter, you actually get slapped with withholding taxes, which is quite hefty. It's about 30% for individual withholding taxes. So, for example, if you were to own Apple shares, if I were to own Apple shares and I receive dividends, or I decide to liquidate my holdings, I will actually be slapped with 30% tax on my profits. Whereas this is sort of you can say it's intelligent / creative kind of engineering or structuring of the REIT. So for Manulife and Prime, right, they actually employ this structure where the capital raise, right, is actually split into an equity SPV as well as a shareholder loan SPV. So most of the money that gets funneled into these assets, like Figura, Michelson, P3, these are all the assets that the REIT holds. So most of it actually, they will try to push it this way into shareholder loans, and then this entity will loan money here so that they can buy the assets.
Right.
And what this means is that because interest and principal repayments, they're actually tax-free. So when most of your money is funneled this way, and then whatever I repay back in terms of interest, whatever, based on my whatever rental I get, I pay for my property expenses, etc. And then I funnel it back and I pay for my interest. And then that is sort of sheltered in a sense. But of course, that being said, there has to be a certain portion of it that is funded through equity. and then this one is taxable. But of course, there are some capital depreciation kind of it's a deduction basically on your earnings that will actually reduce the taxable income. So the goal here, of course, is that they are going to reduce this as much as they can, so that whatever money that goes back here and then gets paid out to the unit holders is virtually tax free. Yeah. So when this money is received in the hands of, for me as a Singaporean investor, I actually do not, because it's already been taxed one time here, technically, I will not get slapped another 30%.
Right.
Yeah. And it's not just for Singapore unit holders. Even Malaysians or foreigners, individuals, I'm saying individuals, not like companies, right, were to invest in Manulife or Prime, they actually will not be slapped with this 30% withholding tax, provided that you, of course, fill in the W9 form. W9 band form. Yeah. Basically, it's a declaration that says that I'm an individual, and then therefore they will not withhold 30% of your distributions.
I see. Okay.
Mm-hmm. So this is a bit.
Are there any capital gain tax on the REITs itself in Singapore if you invest? No, right?
In Singapore, we don't have capital gains at all. Yeah.
Right. Same here like Malaysia also.
Yeah.
Okay. Because there's a question actually from Bill Paris asking whether there be a capital gain tax or not.
Yeah, no. So actually, I think I was listening in on a previous session, which was also on REITs, the previous one. Yeah, I think the question was asked. So yeah, no, there will not be a capital gain tax. Yep.
Yeah.
All right. Okay. So I'll move on. Oh, sorry. This is just to show that actually this is a very similar structure. As you can see, there's the loan side of things, and then this is the equity side of things. Yeah. So it's similar to this loan and equity. Yeah, but of course, as you can see, the structure that they choose to have incorporated here is a vertical structure. So it's like 1 asset, 2 asset, 3 asset, 4 asset. Whereas here is more of a horizontal kind. It's like individual and assets separately. Yeah. So slightly different, but essentially the way the dividends flows back to the investor, the unit holder, is the same. Okay.
Right.
So now we're actually gonna jump into some of our calls, our like fundamentally why we prefer these two counters. But before that, do you have any questions? Or you want to take some questions?
Not at the moment. There's one question just been answered just now. They asked whether capital gain tax or not. So I guess there'll be because if I'm going to invest in even REITs in the US, I'm going to be slapped with that 30% withholding tax, right? So basically, you probably attract. Like even in Singapore, you probably attract a lot of foreign investors as well to actually invest REITs via Singapore, and you can have an exposure in the US REITs market.
I don't know if there's a lot, but that's the thing. So if you do, then that's the benefit that you will get, lah. Whether you fill in that form that says that declare that you are an individual. Yep.
Okay, interesting. Okay.
So this is our one of our favorite counters at the moment, which is Manulife US REIT. So they are actually, a lot of their assets are actually located in tech cities, and so these tech cities in the US, there are certain cities that are they actually are better, or rather more people want to be there. And why do they want to be there? Why do companies want to locate there? It's because the talent pool. Like for example, some of these some of these cities might have very reputable universities that have degrees, or they specialize in degrees in business, or in science, like MIT, kind. So the talent pool is what attracts a company making the decision like, hey, I want to be located here where this talent pool is at. And so the talent pool actually sort of determines which cities are sort of more hotly in demand. And also another thing that that these talented people want is also a very work live play environment. So it's like a not just like all buildings, but it's a very nice balance work live play. Maybe they like to walk to work instead of like commute 1 hour to work. So stuff like that. So a lot of these cities, like for example, your Atlanta, San Francisco, Washington, Dallas, Raleigh, these are some of the cities that have been experiencing very strong tech demand. The tech companies want to be located there, and so they have actually had very positive kind of reversions due to the demand, the pushing up of the market rents in these cities. So actually, for Manulife and Prime, that most of their assets are located within the top 25 tech cities in the US. Yeah.
Right. Right.
Yeah.
So the
So this
focus
is
is on the tech, so-called tech cities, like, where all the tech companies are.
not really. Actually, for Manulife, right? Most of their I'll just show you this. For Manulife, right? Most of their tenants here, they actually are in the legal and retail trade. Legal and retail trade. Yeah. Whereas if you look at Prime, right, they have a more balanced kind of tenant mix where there's actually quite a significant exposure to your tech and your science STEM kind of industry. So it's like science, technology, engineering, and mathematics kind of industries.
Okay.
Yeah. So I guess okay. This just shows you the asset breakdown. So it's also quite even amongst the assets. So there isn't like overly a big asset that actually contributes a lot of income. Then you will see, oh look, there's an asset concentration risk. So it's still relatively evenly spaced out. And then going into some of the reasons why. So this is very similar to why we like the US market. Like I mentioned, the long whales. So I said long whales, 5 years, right? And then you see the expiries in the recent years, 4%, 6%. So meaning to say, if let's say 2021 is going to be a really, really bad year, but I only have 6% of leases that are expiring. So my exposure to maybe a really, really bad low rent is going to be sort of capped at 6%.
Right.
And yeah, so that's a protection that we like and we see in the US office space. I'll show you Prime later. It has a very similar kind of lease expiry structure. So whale weighted average lease expiry structure. Yeah, and also high occupancies because for Manulife, they actually own assets that are trophy grade or grade A kind of assets. And these kind of assets are like, better quality in a sense. So like, they have well-maintained facades. They have been recently refurbished, or of course, location matters. So like in the CBD, right at the heartbeat of Singapore, and these kind of assets actually they attract a certain kind of clientele that you must be able to afford these rents, not just your any Tom, Dick, and Harry of the street. Like they have to have a certain financial standing, etc. And then during periods of economic stress, to actually see a flight to quality, meaning like there are some companies who are currently not located in the CBD area and they're saying like, hey, look, the rents are going down. I think this is the right time for me to actually take this opportunity to go in when the rents are lower in these kind of quality assets because I'm here to stay for the long run. And why not now? So there's this kind of flight to quality, the quality assets. Yeah.
Oh, okay.
So for Manulife, and historically it has been observed that these kind of quality grade A or trophy assets, they do experience this flight to quality. Yeah. So those properties that actually will suffer are those that are grade B and downwards kind of assets that will lose tenants to the grade A tenants, grade A assets.
Right.
So I think like because of the long leases, right? It's only fair that there's some sort of rental escalation written in because who's to say, right? If I were to sign a 10-year lease, how the market rents will be like in 10 years. So usually there is a sort of a step up over the years, like 2% step up to ensure that if let's say the market rents are growing, I must be the tenant is also paying an incrementally higher rent as the years go by. Yeah. So that's basically it. One of the reasons.
Okay.
Then of course, this is the one where I say, the legal and finance sectors. These are, very very long-standing. They're the pillars of the economy. It's not just yesterday that they were formed, or it's not just 5 years ago. And they have traditionally taken up a lot of space in offices. So we can say that they have a long time to actually reduce their floor space, which they have been doing over the years. But you can see that they are still they're still the main lessors who take up office space, generally speaking. Yeah, and these are the pillars of the economy. Yeah. So and also tech is also going to be a very new, more prominent demand for office spaces. Yeah. So another thing is, of course, if you recall in this picture, which is the Gensler survey, physical interaction is viewed as the most effective mode for mentoring, collaboration, innovation, and yeah. So these are the kind of things that actually is value added when you put two people together. 1 + 1 is more than 2, that kind of thing, and you have better ideas. And so, being in a physical setting actually enables it. And this is one of the reasons why some companies continue to want to have office space. Yeah.
Okay.
So this counter is actually covered by my other colleague. Her name is Jie Hui. She's not here with us today. So this is Prime. So as I mentioned, very similar. So Manulife has like trophy assets as well as grade A assets. Prime has more Prime's portfolio is predominantly grade A. So they don't have like the cream of the crop kind, but they have all good quality still grade A assets. Yeah. So very similar. The WALE is actually really long, 4.8 years. And then there's only 3.3% and 7.4% of lease expiring in FY20 and 21. So Manulife, you see, Manulife was like
5.7. Okay.
Yeah. So it's also a very low expiry. Yeah. Okay. Yeah, and also very well distributed. I think you see later. No asset contributes more than 15%, so the asset concentration risk is also low. Yeah, relatively low. Yeah. And in terms of their asset, their tenant mix, right? Office using sectors contribute like I'll show you later. Okay, so never mind. We go to point 2, which is rent forgiveness. No rent forgiveness, meaning during this COVID period, I think you've heard of people getting rental waivers, rental forgiveness. Or some of them are actually mandated by the government, especially in Singapore. Singapore has this like they passed this bill that says that those tenants, they are small, medium enterprises, and they have suffered during the COVID period. The landlords are actually mandated to provide some sort of support for the tenants, give them some sort of rental rebate. So in the US, I think there was very little rental forgiveness. Even if there was in the office building, it would be more for like ancillary kind of tenants, like your coffee shop, your Starbucks kind of like assets that probably they did suffer significantly because your office card suddenly vanished, right? Yeah, 99% of their rents were collected, so that is very positive for the counter. Yeah. Okay. So this gearing headroom, basically gearing is also relatively low, as I mentioned. They always Singapore REITs being more conservative in nature. They try not to go so close to the gearing limit. They are usually around 38%. So this prime is slightly lower, 33%. I mean, of course, now given a more stressful situation, I think some REITs have actually chosen to gear up. And if you ask me, I think that's a good thing because there is, as long as you are prudent enough, you don't have to be you actually lose out from not using more leverage because cost of borrowing loans is always lower than cost of equity. Yeah.
Right.
So by having too low a gearing, it's not that great. You actually lose out to other real estate players. Like in the US, they have no gearing limit. So if they're competing for third party assets, right, at a snap of a finger, they can just take a loan and then they can just gear up to like 50% and slowly reduce the gearing. But in Singapore, you can't. You have the limitation, so you might actually lose out on quality assets. So it's a good thing in my view that some of the SREITs here are actually starting to inch up on their gearing. I mean, it's not towards the 50% level, but maybe like 45. They always keep at least a 5% buffer.
Right. But do you foresee, because right now, of course, there'll probably be opportunities if the prices of properties are going down. But do you see property prices have been going down over the past few years, at least in the short term?
Property prices pre-COVID, not really. I think overall the property prices have sort of increased, also due to inflation, etc. But for right now, even I think a lot of players are actually on the lookout for fire sales where you can get assets at a deep discount, right? Where you have like distressed assets and then like the owners just need to sell them. But there hasn't been a lot of this kind of distressed sales so far, and especially for the SREITs, they are very well capitalized. They don't have the need to sell. So if you're saying about like, would it be a situation where the REITs are forced to sell because they are in danger? They're not really, because they are well capitalized in that sense. And on that front, right, because right now actually interest rates are low. We know that the Fed rate is low. Singapore's interest rate is also low, and generally low interest rates are actually really conducive for the REITs. So every time the interest rate goes down, you actually see that the REIT prices spike because REITs generally they don't ever repay their loans. They always just roll over their loans. So if let's say I have a 3-year loan and then it expires, I take another 3-year loan to roll over. And then of course right now if the interest rate is low, meaning last time maybe my loan was like 3%, now my interest rate is 1%, right? So it's like maybe 1.5%. I actually save on 1.5% of interest costs. Yeah. So in times of low interest rate, it is very conducive for REITs, and REITs actually take this opportunity to start buying more assets, because it means that the yield accretion is higher. Yeah.
Right.
Yep.
Okay.
So that, yeah. So this is the income. As I was saying, I think this is the asset breakdown. Not very nice, even color wheel you see here, and also the sector, the tenant mix. So you have a good balance of finance, communication, some legal, food and accommodation here. So yeah. So, and also you see the scientific. These are like the more futuristic, the STEM industries. So I think the STEM industries contribute about 60% in their portfolio for prime.
Okay.
Mhm. Yeah. And another thing to note is that, of course, I think for REITs, right, the sponsor matters. So if you look at our Singapore market, right, there's a lot of REITs that actually come from very reputable sponsors. Like, for example, CapitaLand. I'm sure you've heard of CapitaLand. They are a very big global real estate player, and they have let's see, I think 5 REITs right now, listed REITs, like your Ascendas, your now CICT, CapitaLand Integrated Commercial Trust. Then you have your Escort Residence Trust. Then they have yeah, I think because of the merger, right, they have fewer trust listed trusts, but there's also one in Malaysia. I think CMMT,
Yep.
CapitaLand Malaysia Mall Trust, or something like that. Yeah.
Yes.
So in Singapore, we have a lot of these very big reputable sponsors. So Prime is also a reputable sponsor that actually provides a ROFR pipeline. ROFR means right of first refusal, where they have these assets that they might potentially want to divest, and before they go to anyone else, they'll say like, "Hey, look, my REIT, do you want to buy it?" So that provides sort of a pipeline of inorganic growth for the REIT as well. Yeah. Yeah. So this is the
Okay.
capital structure. Yeah. So I think this is the end of our presentation.
All right. Okay. Yeah. Okay. Thanks for your presentation. There are some questions I just want to put on hold. I don't want to answer you immediately because most of the questions are based on maybe after your presentation. It's nothing to do with the presentation, but there's one question. But let me just go through. I'm not sure whether you're able to answer these questions or not. Like Sri Kumar is actually asking, to invest in Singapore or US REITs, do one need to open a bank account in Singapore?
Wow, this question. Okay, let me roll to the first slide, and then you can scan it and contact whoever. Yeah, so unfortunately I can't really answer this question. I'm so sorry.
Yeah.
I wish I could, but I really don't really have enough information to answer. You can always just reach out via email to ask any of our trading representatives.
Okay.
Yeah.
Yeah. So this goes to Lim Kok Chin also, because this one is also account related, right? So maybe Lim and Sri, you might want to go and scan and go to the website and get Phillip Securities to actually answer your questions, because this is again more to your accounts, right?
Yeah, actually, I think for this situation, as long as you have some sort of will, or you give the power of attorney to someone to help you execute the withdrawal of the shares, I think that should be fine. But then again, I'm not a tax planner, but this is my hunch, so I think requires further investigation into it.
Okay. Now Xiaoming is asking, this is a more technical question. Natalie, how often are properties valued, if they are, and how does it affect the book value at NAV? And second question, before the pandemic, what would a mean price to book for prime office REITs be?
Okay, so the answer to this question is, in Singapore, the MAS states that the REITs have to value their assets at least one time a year, at least once. Okay, some REITs have elected voluntarily to do it on a semi-annual basis, but because earlier in the year, they actually lifted this regulation. They allowed REITs to do half-yearly reporting. So then again, a lot of REITs actually elected to value assets on a yearly basis. So I think yearly valuations are more of a commonplace for the Singapore REIT market. And how does it affect the net book value or the NAV? That means, okay, so the properties are of course assets. If you have a increase in the valuation, meaning my asset base has grown, right? Then NAV, basically net asset value. So net asset value means your assets minus your liabilities. So if my asset grew by like 25%, well, this is a really good property and grew by 25%, but my debt didn't grow, right? Because I borrowed 100 million from the bank. It doesn't mean that suddenly the bank's going to tell you, hey, now you owe me 200 million. No, because it doesn't go that way, right? So your NAV will increase in that sense, because let's say you initially had 500 million worth of assets minus your 100 million worth of liabilities. That means your net asset value as on a REIT specific on an entity basis is 400 million. Yeah, so it will increase. Similarly, if the assets actually get devalued, then the NAV will fall.
All right.
Before the pandemic, what would a mean price to book for prime office REITs be? I think it was around the 1.1 to 1.2 price to book or price to NAV. Actually means the same thing, like price to book, price to NAV.
Yeah.
Yeah.
Okay. So about 120, 110, 120.
1.1 to 1.2 times.
How much is prime now?
I think it's like 0.9, 0.8.
Because you have a target price of about 0.94, right? If not mistaken, prime.
Yeah, so these two are actually different metrics. Of course, just now we're talking about NAV, right? Normally this NAV it stands for NAV per share. So meaning like, okay, I have 400 million net assets, right? And let's say I have 400 million shares, then my NAV will be 1. That means I invested $1 and I have $1 worth of assets. Okay. And then there's a case where if let's say the number is not 1, right? 1 is a nice round number, right? It means $1 I put in price, I get $1 of asset. But then if let's say the number was 1.5, meaning that I have to pay $1.50, I have to invest $1.50 to get $1 worth of assets. Meaning that this REIT or whatever is trading at a premium. And it's not uncommon. Right now, if you look at Ascendus, actually this number is way higher. This number is correct right now because Ascendus recently took a price beating. So Ascendus is trading at a premium, 1.3, almost 1.4, right? And even worse, Capital DC, you see, 2.4. Meaning I put in $2.40, almost $2.50 to get $1 worth of assets. And it is because data centers are in demand. They are niche kind of asset class, and they're in demand, and they're in the future asset classes, right? So people are willing to pay a premium. Yeah. So currently, right, those that are trading at, you see the decimal points, right, is a discount to NAV. So if you actually look at the hospitality sector, yeah, it's actually worse off the price to NAV. You see Dustin like almost 0.6%.
Yeah, retail and hospitality is taking a big beating, right?
Yeah.
Also, Prime and Manulife is still at is 0.9 and 0.84 respectively. Okay.
So it's slightly below what they would be like around. They are usually trading above book, so usually they will get premium.
But because the price went down that aggressively, that's the reason why it's actually down. Prices.
Because the numerator went down. Yeah.
Yeah. Okay. Kim Boon actually want to look at the USG listed US Office REITs again. Your slides. I think she's referring to your slides.
This US.
Yeah, I'm not sure what question you want to ask. Maybe Kim Boon, you can ask a question based on what you want to look at.
Okay. I think it's this tree that the office ones, right? Yeah.
Okay. So yeah, Kim Boon, you can take a look at this. If you have any questions regarding this, you can ask Natalie. Simbi is asking, I think that's one we already shown that. I'm not sure whether he actually answered this question or he's asking, must trading price always below NAV? What's the nominal discount rates to US office REITs?
I don't believe that the rates have. I'm not sure if what is the nominal discount rate to US office REIT? Discount rate. Actually, I think that more or less they would be similar. The US office and the. Let me pull up my pre-COVID kind of slides here. Okay, I can do it here. So just give me a while to check.
Okay, sure. Yeah, so guys, if you have any more questions, you can ask those questions right now. We only have 20 more minutes left. for you to ask Natalie, and Natalie is actually joining us from Singapore, right?
Yeah.
So make sure you take this opportunity to ask her as many questions right now on the REITs or the US REITs that's listed in Singapore. Okay.
Mm-hmm. So, give me a minute.
Okay, let me just take a poll with the audience here. I just wanted to know because previously Alvin was the one who has been always hosting the Singapore market. But I just want to see how many of you guys out here already have a Singapore trading account. Can you just say yes on the comment section if you have a Singapore trading account, so that at least you know that you guys are investing in Singapore as well.
Okay, so I have your answer.
Okay.
So pre-COVID, I'm looking at some August 2019. So the price to NAV then for your CCT, CapitaLand Commercial Trust, as well as your CapitaLand Commercial Trust, the price to book was like 1.1. Keppel REIT was 0.9. Manulife was 1.1. And then Prime was no, so Prime was just recently listed, so there wasn't any sort of price to NAV. But for Keppel Pacific Oak, it was also one. So the range is always around 1.1, 1 to 1.1, sometimes 1.2. Yeah.
Mm.
So yeah. And then generally your hospitality, you actually see them trading within the 0.8 to 0.9 kind of range. Yeah, and then your commercial assets, your office assets, your industrial assets usually trade at a premium, meaning 1 point something kind of multiple.
Mm.
Yeah. Retail also usually is 0.9, but unless you see those kind of really good quality kind of REITs, then you will see probably a one-ish 1.1. Yeah.
But those are high demand ones.
Yeah, that in a way those that people think are stable and they are willing to pay a premium for.
Okay. Sri Kumar. Sri is asking where is Natalie attached to. Natalie is attached to Phillip Securities Research. So it's Phillip Securities in Singapore.
Yeah. I think there's a Philip also there's a Philip office or what's it called, operation in Malaysia as well, right?
Yeah, there's a Phillip
Yeah, in
capital.
several countries.
Yeah,
Yeah.
Phillip is here as well. So Natalie is based in Singapore, not the Malaysia one.
Yeah.
Okay. Okay, there are quite a number of them actually have accounts in Singapore. Okay, I think that's why they're joining us tonight also. Okay, right. So Natalie, the big question right now, right? The U.S. presidential election. Does the outcome of the U.S. presidential is going to affect the REITs performance in U.S.?
Okay, so I guess if you look at the REITs, right, I think we look at it from a deeper view. So um how well the REITs perform is whether or not their assets are occupied, right?
Mm,
So if more and more businesses start to go under, then there might be more bankruptcies and people who are actually terminating their leases or they're just unable to pay. Then probably the REITs will get hit. So I think in terms of are you asking for a Biden win or a Trump win kind of situation? So if you're looking at from what I'm told, because we do have a US analyst, and I
mm,
actually consulted with him prior to this, so he's telling me that for US for Biden to win, he is more let me see my notes here. He's more okay, sorry. He believes in providing a larger fiscal stimulus, so that will actually help more companies in the near term lah. Not long term, but near term, like your 3 to 5 years, so that these companies do not go under. But also, I think he will then slap a higher tax to actually fund like infrastructure plans that will actually help stimulate the economy, and that just means that in the near term, there will be less companies going under. And also in terms of like his stance, he's more predictable towards foreign policy. Is more predictable stance. So like in a softer stance in a sense. So like Trump is very anti-China. Yeah, but
mm,
I think Biden will probably allow Chinese companies to come in within reason, of course,
mm.
adhering to their privacy laws, etc. So I guess a Biden win would be good for like businesses in general, and then also translate it to the survivability of these businesses that are currently operating and the demand for office space. So that trajectory. Yeah.
Right. Okay, Lilian is asking about, we're still going to go into that in a short while. There's a question from Lilian Tan. Natalie, is low trading volume 1.5 to 2.5 million in the office REIT, SREIT a concern?
That's a good question. Actually, I'm not sure if I have this. Okay, there we go. Okay, so for this slide here, I mean, sorry, I don't have all of the trading volumes. So you can see that Manulife is about, yeah, you're right, about 1.2, 1 point, yeah. So actually, these REITs are slightly smaller. If you compare, I guess, okay, what affects the liquidity or the trading volume of a REIT? Of course, is if I have more shares trading out there, then of course the volume will be higher, right? If I only have 2 cards, there's only a 50% chance that I will use the cards, right? So if you compare it to the larger REITs like your Escort, CapitaLand, Commercial Trust, these are all like double, almost. I think CapitaLand integrated Commercial Trust after the merger. They are $22 billion AUM kind of asset, versus like Manulife, which is just around the 2 billion figure. So I think the size of the REIT matters, and it's true. This trading volume, it matters if you are, for example, a large institution, your insurance company. You need to be able to enter and exit a position quickly without any price risk. You cannot go enter and then like expect to only exit your position after trading, in over a period of like 1 week, 2 weeks. Then of course this trading liquidity really matters to you. And also that also means that these larger counters with greater turnover, greater liquidity, they tend to attract more of these investor flows. Yeah, because the funds are able to pump in money, 10 million, 20 million, and then remove them without actually significant price movements. But I think in general, the US, the Singapore REIT market, we are considered one of the developed REIT markets, but in comparison to the US, of course, our turnover is, to be honest, much lower than the US.
Yeah, I guess it's not as I mean, it's definitely much better than the Malaysian even ETFs and REITs seen here in Malaysia, right? This, I think, one of the questions. I mean, when we have a REITs event or ETF, everybody's asking the same question. Liquidity, how? But 1.5 million or 2.5 million is quite good, really, in my opinion, right? But of course, when you're talking about big institutions, they would are they still like market makers behind the scenes?
Yes.
Yeah.
Yeah, usually I think for those REITs that struggle with getting like exposure. When I say exposure, I mean like eyeballs following the stock. They usually do tend to not tend to. I mean they can. It is not illegal. They can hire market makers to actually help to facilitate, by putting orders at the ask and the bid, so that anyone who wants to buy, they can buy. They're not just stuck there. Yeah. So there are these kind of market making facilities that some of the brokers do provide.
Okay, there's a question here. What's the percentage of retail to institutional holdings in REITs and average? Do you have the number?
Oh no, I don't have the number. Yeah, no, I don't have the number. But I think a larger, I want to say a larger portion is with institutions, but not really. Yeah, I don't really have a number for that.
Okay. Maybe later we get the SGX to provide some info on that.
Sure.
Question over there. Okay, now okay, there's a question here from Sim Winky again. What's your view on REIT ETF versus direct REIT investment?
So I guess the ETF will give you a more sort of diversified kind of portfolio, and I guess that's the one benefit of holding an ETF. I cannot really speak to the rest of the merits of holding an ETF versus a direct investment. So direct investment, I guess, yeah, you're just really exposing yourself to the selected REITs, and it might not be very well balanced. So another thing is you have to actually spend the time to go and study the REITs, not blindly go in, right? I mean, then you might get stuck over there. Whereas I think a REIT ETF is just a very, you can always average in your position, so that you can have maybe a more attractive entry price if it goes down or if it goes up, and you don't have the fear of actually like rebalancing it, having to rebalance it. It's just there and it's diversified. Yeah. So I guess if you just want to like just put your foot in the water, maybe ETF is the way to go. Or if you're willing to just really study up on more of the REITs. I mean, if you had been an early investor in Capital DC, just last year alone you have earned 66% returns. But of course, that would mean that you actually need to sort of do a little bit of homework and read the kind of stuff that I put out or the kind of stuff that the other brokers put out. Yeah. But of course, that means that it's very counter-specific risk.
So I mean, REITs is really a diversified number of property portfolio. So you get ETF on REITs, it's like diversification over diversification. So you have a lot of exposure in a lot of properties.
Yeah. But that's it, right? Actually, Phillip does have 2 of the REIT ETFs in I think, yeah. So 2 out of 3. Yeah. We only have 3 in the Singapore market, so 2 out of 3.
Right. But in terms of performance, I mean, of course, I think if you know which REIT to select, performance will be better than having a bigger set of diversification using ETFs, right?
In a way, yes. If you're really confident and you make the right call, your returns will be way better than if you had diversified, of course.
Right. So I guess for ETF on REITs would be someone who do not really need to do a lot of homework because it's quite diversified, like you say. You can probably average them and you keep on buying, right?
Yeah.
Okay. All right. So coming back to the election again, do you have a statistic or a figure to show what happens to normally performance of REITs after elections, regardless of who wins?
Oh no, we don't have that. No. Yeah, no. I'm so sorry.
Okay.
We don't have that. You can always listen to one of the webinars from my colleague, the US analyst. I guess he can give you a better sensing on, he did this whole scenario analysis of Biden win, Trump win, etc. How which sectors to go into if a Biden win, if you're believing in a Biden win and a Trump win. Yeah, so you can always go to our website to have a look at his report. It's stocksbnb.com. Yeah,
Stocks BNB.
Stocks BNB, which stands for bull and bear.
Oh, okay. So probably tonight he's going to be very busy analyzing stuff.
Yes. You can expect to download from him later.
Okay. All right. Let me see if there are more questions here. Okay, guys. So you have any more? I don't see any more new questions over here. If you have any more questions, you can ask those questions now before we end. And so how can they contact you? I mean, you have that contact number earlier, right? Maybe you want to just show it out again so that they can get in touch with you or your team in Singapore.
Yes, yeah. Okay, sorry. Yep. So our team is headed up by, I think I missed out one of my colleagues. Is he here? I missed out one of my colleagues, yeah. But most of my team is here. I cover the REITs and property, and then also my colleague Jie Hui just now, I mentioned that she covers Prime. So Prime is considered a small cap, yeah. So she's covering Prime. Sorry, I missed out a few of my colleagues here. The US analyst is Jun Rong. His name is Yip Jun Rong.
Okay. Yeah, so guys, do check them out, stocksbnb.com, right? Okay, we have another question here. This is from Lily. Do you add more assets? If so, how often do you shop, and what will make you decide on inclusion or exclusion?
You mean to your portfolio?
I'm not sure whether she's asking a portfolio because I'm not sure whether it's asking about the manager of the REITs, or maybe Lily, you can expand your question, or maybe just clarify your question a bit.
If let's say we're talking about, let me just try to give a holistic answer. Yeah. Okay. If we're talking about the REIT manager, of course, I think the aim is always growing the distribution for the unit holder, because every unit holder would hope to receive higher dividends year on year, right? So one way the REIT can do it via 2 ways. One way is via organic growth, which means that they are able to improve their asset to make it more attractive and attract more demand for the asset, either by beautifying it, making it more tech savvy, the building itself, and then maybe they can command higher rent. So there's organic growth, and then organic rental growth. And of course, another way is for them to grow inorganically, which is acquire assets. So every REIT manager, I think you can ask any REIT manager, they will tell you, yes, I want to grow. Yeah, and of course, there are things that factor in as well, like the proportion of debt to equity. How are you gonna finance this transaction to make sure that it is most accretive for the investor without compromising, without pushing your gearing too high up, or without saddling yourself with fixed debt costs. So it's always how are we gonna grow, and the weightage. So for all REITs, they want to grow. Yeah, and of course there's always a better time to grow, which I mentioned. When the interest rates are lower, it's a better time for them to grow versus when interest rates are high, and then you really have a very high hurdle rate for over which your investments have to earn. Yeah. So if the question is how do you shop, but inclusion or exclusion, it sounds a bit like which counters you will cover. Not sure.
She says to your portfolio. I'm not sure whether I think.
Oh, okay.
Yeah.
I mean, if you're talking as an investor, like, how do I know if I want to have two REITs, three REITs, four REITs? I guess that it's really, I'm not I'm not an advisor, but I will always advise. No, I'm not an advisor, but I always advise. Okay, what I always tell investors is based on your own risk tolerance. So, for example, if let's say if you are a very conservative investor and you do not like very volatile stocks, you do not like stocks that are very subject to the economic cycle. For example, your hospitality, there are good years and bad years, so they are more cyclical in nature, as well as your retail can be quite cyclical. So then you will probably go for a more like industrial kind of REIT, which is more stable. And then how often do you, I guess, if you, first of all, the benefits of adding more assets is that, of course, diversification, right? Because you never know, some unforeseen circumstances that, or risks that you didn't foresee happens to one of the counters. And then if you have two, at least it evens out the swings. You have a more stable portfolio. And of course, what to add really depends on your risk tolerance and whether or not you would like the exposure to that counter. Yeah.
Right. In your opinion, Natalie, do you think that the office REITs has better returns than the industrial REITs?
Office REIT, actually, right? Okay, so it really depends. So I think in Singapore, right, in terms of dividend yield, the industrial assets tend to have a higher dividend yield. So I say higher dividend yield, I mean like in the 5-6% range. This is excluding Keppel DC, because Keppel DC's current share price is crazy high, so their yields are almost like 3%. But in general, most of the industrial REITs, they have about 5-6% kind of dividend yield, and versus your office, which is actually more closer to 4%. 4%. The Singapore office REITs, not the US one. The US one is like close to 8%. Yeah, but that means that you're exposing yourself to another currency, another country. Yeah. So in general, industrial REITs, they tend to come with a higher yield, but there's also a bit of a backstory there, because it depends on the kind of assets they hold. In Singapore, if they are more Singapore centric, Singapore focused, they have the assets that they hold are generally leasehold. That means they expire. They have like a 30-year, 40-year land lease, and they expire. So the reason why the rents are slightly higher is because a part of it is actually capital payments, capital distributions, not just earning distributions. So that is part of the reason why the yields of industrial assets are slightly higher.
Right. And generally, industrial WALE is higher than the office one, right?
I think also really depends. So, like, for example, you see the US one, yes. Of course, like I mentioned, it really depends on where your assets are located. Like, for example, you see your Fraser's Logistics. I think that right now they're called FLCT, Fraser's Logistics and Commercial Trust. So they actually do have quite a bit of assets that are located in Australia. And Australia, the logistic assets, they have a longer WALE. Yeah. So then yes, the WALE there is long. But then if you so actually, okay, the moral of the story is, yes, usually logistic assets have longer WALE, and they can and you can extend your WALE by, of course, acquiring freehold assets or assets overseas, basically. Not freehold assets, but assets overseas.
Okay. Yeah, okay. We have two more questions here before we end. Here we have one from CH Ang. I know that they have been, Prime and also Manulife, their collection is quite good. But what happens if the lease is due, if the lessee cannot pay, then what's going to happen in the US?
So I guess then they will try to I think they will do their usual debt collection, and I think I'm not sure how this goes, but I think at a certain point they can start to evict their tenants. But I think of course right now there should be some sort of like in Singapore that there is some sort of protection period, right, where the landlords cannot evict your tenants. So that is also one of it. But I guess it will go to a more legal kind of approach. Yeah.
Right, not like here, they just come in and just lock the doors and then you cannot come in.
Yeah.
I guess US will take a lot of legal action.
Yeah.
Okay. So it can be a long process, but like you said, most of the units from or investments from Prime and Manulife are trophy and Class A kind of buildings where the tenants also are all A class, what are not like Tom, Dick, and Harry you mentioned.
Yeah.
Okay, so there's some safety net there, lah. Of course, unless they go bankrupt, like one of the risks that you mentioned, that one cannot be avoided, lah, right?
Yes.
Okay, one last question. We have one question here from Kong Xian Jun. In general, is there any fixed structure in charging trust managers fees by trust managers?
Okay, so these are the okay. So for REITs, right, there actually are some fees. There are property management fees, which of course is the fee that you pay for someone to come in and like help you lease out your units, show the units, lease out the units, etc. That's on the property level. Then for your managers, which is the question here right now, there's no real fixed structure. It is the discretion of the REIT themselves to choose the kind of structure that they want. So it could either be like a percentage of NPI, net property income, which is another word for gross profit. Okay, so it could be a percentage of gross profit or percentage of deposited property. Then of course if it's tagged to NPI, then in a way, if the manager doesn't do well, then they have there's more alignment, I guess. Alignment of interest, because if let's say your fee is tagged on the profits and then you didn't do a very good job leasing out the asset, then similarly your fee will reduce, right? Because you didn't get a good rate, etc. You didn't secure a good occupancy. And then of course there's some people who will choose to do it on like based on the assets. So then this one might arise. There might be a bit of a conflict of interest there, because technically speaking, as long as I keep buying assets, right, it doesn't matter if it's good assets or bad assets, then my fee increases. So then there might be a bit of a misalignment of interest there. Yeah. So it really differs REIT by REIT. And of course, some of the REITs, they also do choose to take some of the management fees in units. Yeah. I mean to say they don't take all cash. They take up some in units, so they can have some alignment of interest. And also it also increases the amount that can be distributed to the unit holders because it is not paid out in cash.
Right. So it's unlike like ETFs or unit trusts, because they actually charge 1.5 or 2% annually on the asset under management, right? So REITs is a bit different.
Similar but different lah. Yeah, similar but different, because I mean it depends on how they structure it. If let's say the ETF charges 1.5% on the AUM, assets under management, is comparable to a REIT that actually charges 1% or 0.1% on the deposited property. That means the asset value, AUM also. Yeah, so it just depends on the structure. Of course, it's up to your discretion or whatever the investor feels most comfortable with. There's some REITs that also structure it based on like, for example, there's management fees, and there's management fees are broken out into base fees and performance fees. So meaning to say, if let's say the manager successfully grows the NPI or the DPU by a certain percentage, then they too can share in that incremental percentage. That will further incentivize the REIT managers to work harder. Yeah, so it really depends on how they structure it.
Okay, so every REITs manager, they have a different structure, and of course you can read it all in their prospectus, right?
Yes. Yes.
So so the answer is basically there's no really a fixed structure, right?
Yeah, there isn't.
Okay, awesome. All right, guys. So if you want to download the slides for today, Natalie has actually given us a green light to actually download her slides. Okay, you can WhatsApp us at 84082070. I repeat, you have to put 603 8408-2070. The number is already pointed out on the comment section. Our colleague has already pointed out there. So just click and you just follow the instructions, and then you're able to download the slides from Natalie. All right. Okay, so Natalie, it's already 9:30. Thank you so much for joining us tonight. It's been a pleasure getting you here and learn about US REITs in Singapore.
Thanks for having me, Benny.
Yeah, hope you wish you all the best, and hope to see you again. Yeah.
Yeah, thank you. Stay safe, everyone.
Yeah, you too.
Bye.